Hello, everyone, and welcome to our real estate workshop. Whether this is your first time joining us or you've attended other sessions, again, welcome. My name is Michael Matthew. I've been a professional accountant for more than 30 years. My international practice is increasingly focused on real estate and real estate investors. I'm also the CFO for a home builder. I provide services such as entity structuring, setting up both in Canada and the US, operational and tax consulting, tax return preparation for both Canada and the US. I currently own a condo nearby, and I'm looking for a small apartment built in the US, initially in Texas. Plans for the group is to meet on the last Thursday of the month, subject to change around certain events, such as holidays, at 7 p.m. I deliver some of the content, and we also have guest speakers like tonight. We'll address various issues related to real estate investing, including additional considerations for investors with U.S. properties, accessing other allied professionals, financing, etc. So to keep my lawyer happy, a brief disclaimer. None of the information provided in this presentation or provided through this presentation is provided as tax, accounting, or legal advice, and it shall not be relied upon as such. None of the material is to be construed as a solicitation, recommendation, or offer to buy or sell any security, product, or instrument. I do my best to make sure the information is as up to date as possible, but new tax cases are being decided all the time. New legislation comes out all the time, and please check with your tax advisor before making any real estate investment to make sure you have the most up-to-date information possible. So as you have questions throughout tonight's presentation, please just put them in the chat and we'll deal with them at the end. If you have more involved questions and you'd like to have a one-on-one conversation with me, I offer a free 15-minute consultation. Just email me at the address on the screen, michael@mmcpaca.com, to arrange a mutually convenient time. So tonight, our topic is multifamily investing, and we have a special guest speaker tonight, Mark Gonneau. Mark is an award-winning real estate investor who began investing at the age of 24 while still a student. Since then, he has invested in various forms of real estate across Canada and abroad. He currently owns 264 units across 42 properties with a value of over 70 million. He was named top 10 investor in Ontario in 2008, 9, 11, 14, and 15, as well as Player of the Year in 2014 by REIN, which is the Real Estate Investment Network. He is focused on helping professionals and business owners grow their nest egg by investing in value-add real estate opportunities. And with that brief introduction, Mark, I'll turn it over to you. You should be able to start screen sharing because I believe you have a brief presentation for us.
Sure, thank you. Let me see if we can get this going.
Yeah, we see your presentation.
Perfect. All right. And I was going to say, in light of the fact we've got just a handful of people here, if people do have questions along the way, by all means, just jump in. So yeah, I'm basically here to talk about multifamily investing. So the first thing I thought I'd do is chat about sort of why am I here? Why did I get brought on here as an expert? First thing, that's me, and I'm a dad, and obviously a husband, and these guys are the reason why I do everything that I do. Obviously also an investor and an entrepreneur. And as Michael said in the bio, I bought my first property when I was a student at university, and I've acquired a few since then. I've done a lot of different real estate investing. I've done pre-construction condos, I've done single family rentals, I've done rent to owns, I've done bridge loans, I've done second mortgages, both RSP second mortgages and regular second mortgages. I've done flips, I've done BRRRRs, I've done duplexes, multifamilies, and actually now I'm buying hotels, which we'll get into a little bit later. So the first thing I want to talk about, we're talking about making the jump from sort of onesie twosie type properties into multifamily properties. So the first question, of course, is why? Why would somebody want to make the jump into multifamily properties? And as I like to say, is the grass really greener on the other side? So there's going to be some advantages and some disadvantages when it comes to multifamily investing. So quickly going to run through some of these advantages, disadvantages. Of course, the advantage, you have many units under one roof, which means you have easier property management. You typically have a lower cost per unit. A lot of times a multifamily property is bought for $100,000, $200,000, $300,000 a door, whereas to get the equivalent in single families, you're paying $500,000, $600,000, $700,000 a door. They are easier to refinance and easier to scale, simply because you don't run into the mortgage headaches that you do typically run into with single family properties. Some of the disadvantages, of course, you are dealing with bigger dollars, and you can make bigger mistakes. If you make a mistake on a little property, on a single family home, it costs you thousands or tens of thousands of dollars. If you make the same mistake on a multifamily property, it starts at tens of thousands and can get into hundreds of thousands. You have to put more money down because it's a larger property. You have acquisition fees in multifamily that you wouldn't normally have with single family homes or residential properties. The repairs typically are more expensive. But to me, the biggest thing about multifamily that I like, and it's something that people that know me hear me say all the time, it's not emotional, it's just math. And where that comes in is really in the valuation and the operation of the properties. So if you think about residential properties, whether it's a duplex or whether it's a single family home, triplex, condo, that sort of thing, value is determined essentially by the comparison approach. So that essentially means, well, the house next door sold for 500,000. This house is the same model of house, the same style of house, same number of bedrooms, that sort of stuff. However, this one is a little bit nicer because it's got hardwood floors instead of laminate, or recently had a renovated kitchen, and you assign some sort of value to it, but you're always really comparing one property to another. However, with multifamily, they're prominently valued on the income approach. And this is really when I talk about it's not emotional, it's just math. So any discussion about multifamily properties and sort of their valuations, we have to have a discussion about cap rates. So a cap rate, just to define it in case people here aren't aware, is the net operating income divided by the current value of the asset. So if you have a property that is making $100,000 a year and it costs $1 million to buy it, then you're going to put $100,000 on the top half of that equation and $1 million on the bottom half of the equation to get your cap rate. And just to make sure we cover this part, NOI, or net operating income, is your income minus your expenses, but it doesn't include your mortgage. So this would be your rents typically, maybe some laundry money, some parking money, minus your expenses, which is going to be property tax, insurance, maintenance, your vacancy expense, your management expense, snow shoveling, accounting, bookkeeping, all that sort of stuff. So just to quickly run through an example, if you have a multifamily building where the purchase price is $1 million and its NOI was 100,000, then the cap rate is 100,000 divided by 1 million, which means it's a 10% cap rate. Whereas if you had the exact same building with the exact same purchase price of $1 million, but this time it only made $50,000 a year as an NOI, the cap rate there would be 50,000 divided by the $1 million, which works out to be 5%. So typically you'll get a real world example like this, where you have something that's given to listing that's given to you by a realtor. The math is the same, it's just not quite so easy. 3.65 million was this particular property's purchase price or asking price. The NOI was $202,978. So the cap rate here worked out to be 5.56%. Now, different cities have different cap rates, and the cap rate itself for the different cities is sort of a function of supply and demand, and it kind of reflects the perceived security of the market. So something like Toronto will have a very low cap rate because it's seen as being a very secure city. And by secure, I don't mean from a crime standpoint, I mean from an investment standpoint, in that there's always going to be lots of people who want to buy in Toronto. Hamilton has a slightly higher cap rate, whereas a place like Timmins has a significantly higher cap rate. And that, again, we're getting down to supply and demand. There's more people who will want to buy a property in Toronto than there are in Timmins, and Toronto is seen as being more secure. So therefore, the cap rate gets bid down in Toronto as compared to Timmins. It's sort of a risk reward type of scenario as well. Timmins is seen as a riskier market, therefore it pays a higher cap rate to compensate for that risk. So question people always ask is, what's better, a 10% cap or a 5% cap? Do you want a high cap rate or do you want a low cap rate? The answer, I hate to say it, is it depends. It depends on your goals. It depends on what you're looking to do. It depends on your age, your demographics. It depends on quite frankly, what it is that you're wanting to get out of the property. Are you looking for a property that you can add value to buy a property at $2 million and turn it into a $5 million property? Or are you looking for a property that's going to be completely turnkey and not require a lot of work? Are you looking for something that's just going to kick off a lot of cash flow and you don't really care about the appreciation? So that's, I hate to say it, but it really does depend. So getting back to our example here, again, purchase price of $1 million to keep the math easy. At a 5% cap rate, we knew that the net income was $50,000 per year, but that didn't include the mortgage. So if we put 70% down, therefore we have a $700,000 mortgage, and let's say we're paying 4% interest, and it's a 25-year amortization on the mortgage. So our mortgage payments are $44,184. That means our annual cash flow is only $5,816. So I had to invest $300,000 to buy this building, and that's just with like simple math because we didn't include any of the acquisition costs, like land transfer tax and everything else. So I put $300,000 in, and I'm only getting $5,816 out. That's a 1.93% cash on cash return, which, let's face it, is pretty dismal. Now, if we go with the same building, same purchase price, only it had a 10% cap rate, we know the NOI is going to be $100,000 a year. We're going to put the same 70% down, which gives us a $700,000 mortgage. We're going to assume the same 4% interest, 25-year amortization. Our mortgage payments are still the same, $44,184. But our cash flow is $55,816. On $300,000 invested, we get 18.6% cash on cash. So significantly more. And so this again is where we talk about, are you investing for cash flow? So getting back to the other question, what's better, a 10% cap or a 5% cap? And again, the answer is, it depends. So at a 5% cap, every dollar increase in the NOI increases the value of the building by $20. So you raise the rents by $100 a month, that means $1,200 a year, then you're going to increase the actual value of the building by 20 times that. At a 10% cap, every dollar you increase in the NOI, the value of the building only increases by $10. So this gets back to, once again, what's better, a 10% cap or a 5% cap? We know that a 10% cap will kick off more cash flow, but there can be situations where you want a low cap rate, when you want a 5% cap. So as an example, here's my dad. So he's having a little snooze on the hammock at the cottage. So what's better for him? Because if you're my dad, you really don't want to do any work. You want a nice turnkey building that just pays you, let's call it a pension every month. You're far more concerned about the cash flow than you are about the capital appreciation. So someone like my dad is looking for a building with a high cap rate because when he puts his $300,000 in, it'll make him $55,000 a year, cash on cash return. However, if you're a little younger, like me, and if you're working and you've got a day job that's paying all your bills, and you're not as concerned about the actual cash flow of the property, you're concerned about building that nest egg, you're concerned about growing your money, then you can actually create more appreciation on a building with a low cap rate than you could with a high cap rate. So how do we increase the value in a multifamily property? Now, getting back to this, remember we defined a cap rate as the net operating income divided by the value of the asset. So using the math tricks that I learned in school years ago, you can switch this around and say the value of the asset is the net operating income divided by the cap rate. So if the cap rate stays the same, then the value of the asset will increase as the net operating income increases. And if you remember my slide from a few slides ago, at a 5 cap, it increases by a factor of 20, whereas a 10 cap, it increases by a factor of 10. So how do we increase the NOI? You can either increase the income or you can decrease the expenses. There's really only those two options. So how can we increase the income? Lots of different ways to do this. We can raise the rent. We can charge for parking. We can add lockers. We can have laundry income. We can potentially add additional units into the property. We can convert 2-bed units into 1-bed units because typically you'll make more money with 2 1-bedroom units than you would with 1 2-bedroom unit. You can do things like adding solar panels. I have a building with a cell tower on it. There's lots of different things you can do to increase the income. Now, when it comes to decreasing expenses, let's look at the different categories that we're working with a building. We've got property tax, insurance, property management, maintenance, vacancy, and utilities. And that's pretty much the broad categories. So can we decrease the property tax? No. Can we decrease the insurance? Not these days, it's only going in one direction. Can we decrease our maintenance expenses? Possibly, but it's really short-sighted because it's just going to come back and haunt you later. So that's not a good option. Can we decrease our property management costs? Again, possibly you might find somebody who's able to manage the property for less. You might do the management yourself and save that cost. But again, that's not a long-term solution. And a lot of times you get what you pay for when it comes to property management. And if you switch to a property management company that's offering a cut rate price, you're usually getting cut rate service. So we can potentially decrease the vacancy and we can decrease the utilities. And those are pretty much the only two levers that we have when we're working with trying to decrease the expenses on a property. So how do we decrease the utilities? And separate the meters and offload the cost of utilities to the tenants. We can install LED lighting in the common areas. We can put in low flow fixtures. We can install solar panels. Now, this is going to seem kind of funny, I know, but to me, nothing sort of exemplifies the ability of multifamily to be able to increase the value of multifamily by decreasing expenses through something as simple as a toilet. So old toilets can use as much as 6 gallons of water per flush. We assume 3 people are living in a 2-bedroom apartment, 3 flushes per day per person. You've got 9 flushes a day. That's 205 liters per day that's flushed down the toilet, which is 74,600 liters per year. In the city of Hamilton, where I have a number of properties, the cost of water is $1.68 per 1,000 liters. So that family flushed approximately $125 in water down the drain each year. If you instead installed a low flow toilet, some of these low flow toilets use as little as 3 liters of water per flush. So we use the same family that used 9,855 liters per year of water flushing toilets. Now, sorry, that same family uses significantly less. They only use 9,855 liters per year, which is about $16.50 in water per year. So that means you saved $108.50 per year. But that means you just increased your NOI by $108.50. At a 5% cap rate, $108.50 divided by the 5% cap rate is a $2,170 increase in value in the property. It costs about $300 to replace a toilet, which means your net is $1,870 in increase in value in the property. So let's say this was a 12-plex. That means you've increased the value of the property by $22,440 just from changing out the toilets. And if this was a duplex and you changed out the toilets on a duplex, it wouldn't change the value of the property. This is where I talk about my favorite saying, it's not emotional, it's just math. The math on the toilets is the math on the toilets. And it actually works even better with things like low flow shower heads because you save even more water with those. So just going to chat through some examples of properties that I've purchased in the past few years and just sort of walk you through the numbers with them. So this is a little 12-plex I bought in Hamilton. I paid $1.65 million for it in 2019. This is what it looked like when I bought it, certainly out of date. I mean, when it comes to buying multifamily properties, what you're looking for first and foremost is location. Just like with single family, you can't move the property, so you want to buy something that's in a great location. Second, you want to buy something that has good bones, as I describe it. You want something that is mechanically sound and structurally sound, but you want something that's cosmetically dated like this one. And you want something that maybe is poorly managed. You want something where the person that owns it hasn't raised the rent in a long time. That just allows you to get in there and manage the property better, increase the rents, use some different things. I mean, I've seen buildings where the coin laundry is still set to $1 a wash and $1 a dry because the owner hasn't changed the price in 30 years. Well, today you can switch that up to $2.50, $3 a wash. I've even seen it higher than $4 a wash and a dry. And all of a sudden you've increased the value of the building significantly because you've increased the NOI for doing nothing other than just changing the value of, like, changing how much you charge for laundry. So this building here, again, great location in Hamilton, structurally sound, nice brick, purpose-built 12-plex, but cosmetically dated. So we went in and we renovated these units. So obviously looking significantly better now, we're able to get better rent. So walking through the numbers here, purchased it for $1.65 million. At the time, the average rent was $908 a month. Our rental costs, because they are quite substantial, is about $40,000 a door. We're going in, we're putting in new flooring, obviously repainting everything, new doors, new trim, full kitchen renovation, full bathroom renovation. We're adding things like air conditioning, we're adding ensuite laundry. So we're talking about $40,000 a door for the renovation. However, our new rent is about $1,750 per month. So our increased rent is $840 a month, which works out to $10,800 per year. A GATA 5 cap, that $10,800 per year, is approximately a $200,000 increase in value in the property. We subtract out a rental cost of $40,000 a unit, and that means that property is now worth a net gain of $160,000 for every unit that we renovate. At 12 doors, that means there's 1.9 million in potential total gain for turning over that property. As I like to say, it's not emotional, it's just math. Here's another example here. We bought this building for 1.8 million. It has a sixplex in the front that was completely gutted back to the bricks and rebuilt by the former owner. And actually they even put on a new roof and redid the bricks. So it's pretty much a brand new building. In the back, it had 6 townhome style units. The previous owner had gutted them, but he was in the process of rebuilding them. He got taken down by cancer. He spent 2.5 years in and out of Princess Margaret. The good news is he's okay now. Cancer's in remission, which is great. But at the time, he decided he likes fishing a lot more than he likes rebuilding apartment buildings. So we were able to buy it off him in this state. This is what the front half, the sixplex units looked like. So they were completely rebuilt condo standards. This is what the back townhouse units looked like when we bought it. So again, we bought this for 1.8 million. Rental costs were obviously substantial because we just inherited a brick shell at 880,000. In September 2020, about a year and a half after we bought it, it was appraised at 3.3 million. So if you take out a rental cost of 880, carrying cost about 100,000, net gain 3.3 minus 180 minus 80 minus 100,000 means we made 500,000, just over $500,000 in this property in just over a year. And again, all it was just doing the renovations and then putting the tenants in. So again, it's not emotional, it's math. Here's a final example. Really like this building out in Barrie, actually, 12plex that we bought. A little bit more expensive, 2.5 million that we bought this for a little bit more recently. Average rent is $1,163 a month. Really nice building. The rental costs aren't as much with this one. We're 15,000 a door on average. Our new rent is actually just over $1,800 a month. So we're increasing the rent by $637 a month, or just over $7,600 a year. Again, at a 5 cap, we're looking at $152,000 gain per unit, minus a rental costs, means we're about $135,000 gain per door. We've got 12 doors in this building, so again, it's 1.6 million gain to turn over that property. So again, it all comes down to how do you increase the NOI? And as I say all the time and time again, it's not emotional, it's math. It's just what can we do how can we move those levers so that we can increase the NOI? So investing in multifamily property really comes down to 3 things. So the property, the money, and the knowledge. So when it comes to the property, there's a lot fewer multifamily properties out there. If you think about it, there's 1 billion condos in Toronto, and most of them are very similar. But there's only a few dozen 100-unit buildings, and even fewer of them are actually any good. When it comes to money, it can require significantly more money to buy a multifamily property than compared to a residential property. It's also significantly more to repair them. Down payment can be more. You can be looking at 30-35% down for multifamily versus 20% for a single family. You also have all these costs that you have to look out for and budget for in a multifamily that you don't have to budget for in a single family or a residential property. In an appraisal, you're looking at roughly $3,000 to $4,000 for an appraisal. Single family, they cost you $300-400, sometimes $500 these days, but half the time the bank pays for the appraisal, not you. Whereas in multifamily, because it's in the commercial side of things, you have to pay for the appraisal. In multifamily, because it's commercial mortgage, you're paying for a phase 1. Again, roughly $3,000 for the phase 1. Single family, you don't have to worry about it. Financing costs. Single family, you don't have to pay the mortgage broker typically. They get paid by the bank. In multifamily, it's not the same. With commercial mortgages, you're usually paying about 2% of the cost of the mortgage to the mortgage broker to get you that mortgage. And also you pay to the bank a financing fee as well. Just costs for repairs, of course. You've got a bigger roof. It's $50,000 for a multifamily to replace a roof. It's $5,000 for a single family. boiler or a furnace, I've had to replace these as well. You're talking 35,000 or more for a multifamily. $3,000 gets you a furnace these days for single family. Knowledge. So you can try to do it on your own, but remember, when you have bigger deals, you have bigger mistakes. So there's no safety net and the mistakes can be larger. So the bank is actually looking for more than just, do you have the money to buy the property? They're looking for experience. They're looking for whether or not you've done this before. Something that seems kind of strange is I own a fair number of properties. Because of that, it makes it incredibly difficult for me to get a mortgage on a single family home. But if I'm buying a 20-unit building, the banks like it because they know I've done this before and they know that I have the knowledge. So some of the pitfalls, we've talked about this a couple times already, but not enough money. I've heard a quote that said 80% of businesses die because they're undercapitalized. If you're in a situation where you spent all your money to acquire the building and then you have to replace a boiler within the first month of you buying it, which I had to do, there's $35, $40, $50,000 just for a small boiler. It was actually on that sixplex, the townhouse style units in the back, and there's the sixplex in the front. That property, within a month of buying the property, the boiler died. We had to put in a new boiler. It was around $35,000. If you would spend all your money buying the property and you don't have enough money to fix the boiler, it obviously can be a problem. Buying the wrong property. I mean, yes, you can toss enough money at something and you can fix anything, but you don't want to be in a situation where you've got more money in the deal than it's worth, where you bought the property, but you have to do so many things to renovate it, so many things to fix it, that it just, the fixes that you're doing aren't increasing your NOI. It's not bringing up the value. And not knowing enough, or as some people thinking they know more than they actually do. So how do you invest in multifamily without the risk? Start small. Is usually the best thing to do. Start with single family homes, go to a duplex, go to a triplex, and then grow bigger. Probably wouldn't recommend the very first thing you buy is a 200-unit apartment building, because again, the risks are much larger, the dollars are much larger, the mistakes can be much larger. If you're going to do it on your own, you got to make sure you have a great team. This is somebody like a mortgage broker who specializes in multifamily, a realtor who specializes in multifamily. You need a good lawyer, you need a good insurance person, you need a good property manager. You want to make sure you really build that team around you of people that know what they're doing, have done it before, so that they can help you. Of course, partner with somebody who knows what they're doing. That's a great way to get started in multifamily, is partnering with somebody who's doing it. And that way, of course, you can learn from what they've already made the mistakes on. So what am I doing right now? Just as a little side note, I am actually buying hotels right now. And what I'm doing is I'm buying these hotels and little boutique hotels. This is one that I've bought in Quebec City, which has got some very interesting architecture. I'm buying hotels because they fall outside the landlord-tenant board. I'm buying hotels right now because they're actually at great valuations. I'm buying hotels because I can turn the whole thing over in under a year, whereas with multifamily properties, it takes me a lot longer. Now, what I do with them is I actually convert them into extended stay properties. So what I do is I go in and I renovate them, I add kitchens, and that allows people to stay for much longer. Of course, same things that I look for in multifamily, I look for in the hotels. I want to buy a prime location first and foremost. I want to buy something that's structurally sound, something that's mechanically sound, but I want something that's cosmetically dated, something that isn't operating as efficiently as it could. So I go in, I renovate it so it looks much nicer. I add the kitchens, so now I can operate it as a hotel because I have the license. I can also operate it as a multifamily, or I can go in between. Some of these properties are located close to post-secondary education, so I have the ability to rent these September to May to students, and then rent them May to September as a hotel. The important thing is because I have the license, I have that flexibility. I don't have to worry about Airbnb regulations or short-term rental regulations. And that gives me a lot of downside protection. So that's sort of what I'm doing right now. How can I help you? I am a licensed realtor. I have a team that I work with, and we do a lot of commercial real estate and a lot of multifamily properties. So I can help you buy your property as your realtor. And as I like to think it, it's kind of like getting free coaching because you benefit from my experience, but you're not paying $40,000 for coaching. I just get paid a commission if you buy something. And of course, I'm not going to sell you something that I wouldn't buy myself. If you're an eligible or an accredited investor, you might qualify to participate in upcoming projects with me, either as joint venture partners or potentially even an investor in my fund. And if you're interested in exploring either option, just reach out. Here's my contact info. And yeah, let's see if anybody has any questions.
Thank you for that presentation, Mark. It was very informative. I appreciate the practical examples and the numbers. I mean, I'm an accountant, so you can never have too many numbers in a presentation.
It's not emotional, it's just math.
That's it. I know you said you started focusing more on hotels of late, but when you're looking at the multifamily residential, how do you pick a property?
Well, like I said, the first thing, I mean, it's the age-old rule when it comes to real estate is location, location, location. So you want something that's in the best location possible because you can never move that property. Anything else you can change about it. As I've said, I want things that are structurally sound. I want things that are cosmetically dated, things that aren't managed property.
Okay.
Sorry, just had to take a quick drink there. And otherwise, it depends on how much money I'm working with. It depends on what, as I said in the example, is it my dad that we're looking for a property for, or is it me? My dad wants something completely turnkey. He doesn't want to do a lot of work. I'm at the point where I'm still building that nest egg, where I'm still wanting to build that wealth. So I'm looking for the value add side of things. My dad wants a high cap rate because it gives him more cash flow. I'm looking for a low cap rate so that my renovation dollars have a bigger pop when it comes to the value of the property.
Now, are you finding these listings through the MLS or are you finding them other ways?
I bought off MLS and I've bought direct from sellers. I've bought pocket listings through other realtors. To me, I mean, I've bought from wholesalers. I don't really care where, like, who finds the property. I just care about how good the deal is. If it's a good deal, then you buy it regardless of who actually brought it to you or how you found it.
Okay, thanks for that. George, did you have a question or anyone else have a question?
Not at this time, but I hope everybody knows that they could unmute if they had a question to ask. Um,
Okay, well, if no one has a question, then I think we can just wrap it at that. Oh, there's a question in the chat. They wanted to know, Mark, how long you've been doing multifamily investing.
Quite some time actually. I first started investing when I was 27, while I was a student at university. Bought my first property, and the first multifamily property I was invested in was about 5 years after that. And then, yeah, I've continued to buy since then.
In my experience, most people start out with single family investing, and if they're going to go to multifamily, it's after, but it seems like you started right away. or started earlier, at least with multifamily?
Yeah, I mean, I did a lot of single family at the start. My first investment was essentially house hacking before house hacking was a term. Where I bought a place while I was in university, and my roommate and I actually bought it. We built what was probably an illegal basement apartment in it, and my roommate and I lived in the basement, and we rented out the rest of the house to classmates and to help us cover the mortgage payments. So that was the first investment. After that, I did. I waited till I graduated, sold the property, paid off some student loans, and then started buying single family. Would buy single family homes and student rentals. The first multifamily that I got into was a joint venture with other more experienced investors, where we bought it was 38 condo units. The building had been already severed into condos, so there were 38 individual titles. I bought 3 of which. My brother bought 5 or 7, I think it was. Another investor bought 16, and there was just a group of investors that took down all 38 of these properties. From there, I still did single families. I still did duplexes, and then picked up a 14-unit building, picked up an 18-unit building, and just kept on going from there.
Okay. Thanks for that. Any other questions? Please type them in the chat or just unmute yourself and ask them. Okay, so it seems like no one else has a question. I guess your presentation was just so clear, Mark, that there's nothing they could possibly. Oh, they want to know how much down payments, how much of a down payment you used. I think you said it's usually for 30 to 35%. Was that right?
Yeah, it depends on what you're doing. If you're buying a turnkey property, then you can go CMHC financing right from the start at up to 85% loan to value, so only 15% down. The one thing to keep in mind is when you're doing CMHC financing, is it's 85% loan to CMHC's value, which is not always the same as the market value or what you paid for the property. And quite frankly, it's almost always significantly less. So 85% of CMHC's value is usually about 75% of the market value, as just a quick rule of thumb. But if you're doing a value add type of play where you're looking to buy the property and do the renos and increase the value, the typical process that people will do is you buy the property using potentially a B lender because the property isn't going to cash flow. So you need the flexibility of that B lender. A lot of times the B lender will give you some or potentially even all of your construction costs as a second tranche of the loan. So you use that B lender at the start to be able to buy the property and do your renovations. And then once you've turned over a significant portion of those units, then you exit that B lender using CMHC financing at the new value. When you're buying with that B lender, yes, they'll give you the construction financing or a portion of it, but you're usually capped at 75% of the value of the property. Sometimes it's even 65%.
Right, right. Okay, any other questions today? Feel like an auctioneer going once. Okay, yeah. So the question was, how long does it usually take to go from a B lender to the CMHC financing?
It depends on how quickly you turn over the building. A lot of times with multifamily, I personally budget around 4 or 5 years to turn over the building. I've done it as quickly as about 14 months.
Wow.
But that's exceptional and certainly not doesn't happen very often, especially here in Ontario where you have the landlord tenant rules. You just can't tell people to leave, or if somebody wants to stay there, they'll stay, they have the right to stay there. Whereas if you're in other jurisdictions, you have the ability to increase the rent, or the lease doesn't automatically renew at the end of the term, and you could, as a landlord, can choose not to renew a lease. So in other jurisdictions, you can do it a little quicker than you can in Ontario.
Okay. And I think there was a follow-up there. Just gonna scroll up a bit. For the B lender, question was, do you usually have a fixed or variable mortgage?
Typically, the B lenders are variable, and they're expensive. So for a lot of these, when you're going in with a B lender, you're looking at rates of like prime +2, prime +3. I've seen prime +8.
Wow.
So yeah, so people are going in and they're paying 14, 15% right now, interest only on the loan. But the idea is it's just another line on the spreadsheet. This is a short-term thing, and you just have to budget that in when you do your budget for the property, is what that interest cost is. I mean, obviously you want it as low as possible, but right now, low is relative.
Yeah, and as you say, it's about the math, right? So if you can get
Yeah.
that higher interest rate to work, because it's, as you say, a short-term play, then it can make a lot of sense to pay that 14%.
It's just a line on the spreadsheet. So you put your purchase cost in, you put all your acquisition fee costs in, you put your renovation costs in, you put your carrying costs in, and you put in what the value is at the end, and you see what that number is. And if that number makes sense, and if all your assumptions are good, and you're not assuming that you're going to turn over an entire building in 6 months, then sure, go ahead, pull the trigger.
Okay. Next question was, do you need a license to run a hotel? Because you mentioned you're buying
Yeah.
hotels these days.
Yeah, so that's actually what I really like about the hotels, is the hotels that we're buying are licensed hotels, which means I can always operate them. So when Airbnb comes in and shuts down, or when the municipalities come in and shut down Airbnb and other short-term rentals, that's actually driving money into my pocket, because that's just taking away competition. Um, and it's one of those things where all A's are B's, but not all B's are A's. And what I mean by that is, as a hotel, if I've got the facilities like kitchens and ensuite laundry, so it looks and feels like a multifamily, but I've got that license, the license allows me to rent by the night, but there's nothing that stops me from renting by the day, the week, the month, the year. However, if I'm a multifamily property and I don't have that license, I'm not allowed to rent by the night. I can only rent long term.
Right. So you're buying the license with the building then.
Yes.
Okay. Next question. Do you refinance every 5 years or so with the
So
properties you're buying? I guess they're asking about exit strategies.
yeah, so I mean, exit strategy can be a sale. Exit strategy can be a refinance, which is essentially a BRRRR type of method. CMHC mortgages, you can typically are 5-year or 10-year mortgages. You can get other variations, excuse me, but most people, they're doing 5-year or 10-year mortgages. So yes, a lot of times you'd refinance every 5 years.
Okay. Any more questions for Mark?
Oh, and one thing that I should mention, I didn't have the big disclaimer slide that you put up at the start, but please assume that applies to my presentation as well.
Yeah, it is meant to cover yours as well. So I actually got that from my lawyer. So
It looks quite well done.
yeah, it's just it has to be done.
Unfortunately, yes, that's the world we live in these days.
Exactly. Yeah, so someone was asking how they can partner with you. The first step would be to get in touch with you.
Send me an email.
We put your contact information in the chat. And I'll just put it in again. Is it, so you don't have to scroll up?
And well, I have half a dozen different email addresses, so whichever one you put in, I'm sure we'll still get
It's
to.
the Honey Tree Grow one, and I
Yep,
see
that
that
one'll work.
there's a different one on the screen, so
Yeah, on the screen I put the armchair investor. Either one's, they all get to me.
yeah, I myself, I've lost track. It's upwards of 15 email addresses.
Yeah, exactly.
One phone number.
But and they all go to the same place. I mean, they all go here. So that's all that really matters.
Exactly, exactly. Okay. Oh, Rick, go ahead. Did you have a question?
Well, hi there. Hi, Mike. Hi, Mark.
Heather.
No, it's very informative. So just I have a question for Mark. Like, I know yourself, like when you first started house hacking back when you were earlier age, but like for something like us, like in the middle age with families, and we- it's really hard, difficult for us to do house hacking like to start it,
Yep.
and like situation like that. How would would you be able to like start with any type of investing, right? It's, it's one of the questions I always have because I've been to different real estate events group like meetup groups since 2018.
Mhm.
But the thing is like at the end of the day, like without any really capital, like you can't really do anything on it.
Um, yeah, I mean, obviously, real estate investing is a capital intensive project. If you're buying $1 million house, the $1 million has to come from somewhere. The good news is the vast majority of it comes from the bank. Um, the rest of it, yeah, it has to come from somebody still. It doesn't necessarily have to come from you. So you can, if you have the capital, great, you can use that. If not, you can partner with other people who might have the capital. So if somebody's coming out and they have absolutely no capital and they're brand new at the game, my advice is the first thing I would do is find somebody, like obviously one through groups like this and through meetups and all the different things that are available, books and online forums and stuff like that, to be able to learn and be able to get knowledge that's theoretical knowledge. Go out and shadow somebody. Find somebody that is willing to let you just tag along with them so that you can see what they do, how they do it, how they think about things. Because a lot of it is mindset and thinking about things. I mean, paying 14% interest for a mortgage to somebody who isn't in the game seems absurd. But if you're a developer and you're wanting to buy a house and knock it down and rebuild, or you're trying to build a subdivision, 14% interest is just the going rate. And again, it's just another line on the spreadsheet. And if the math works, the math works. So that's certainly something that I can recommend. The other thing is you still will have to, so you can do one of two things. You either go get the knowledge so that you have enough knowledge to be able to, the word that comes to mind is convince, but I don't want to say convince, but let's just say convince somebody else who has the money to invest with you as the money partner. But that means you're the one that has to have all the knowledge. So you have to put in the time to gain all the knowledge so that you can then go out and be the knowledge partner, the operations partner on that property. So that's one way you can start to jump in. And I know some people who've done phenomenally well with that, where they came in as the knowledge partner, as the operations partner, before they even bought in a property themselves, but they had done all the theory, they had worked for people for free who were doing things, they followed people around, they did stuff on the weekends and evenings, and just so that they were able to learn and get that knowledge.
Mm-hmm.
Go
Thank
ahead, Rick.
you.
All right, well, just to add to what Mark was saying, Rick, that regardless of who you're talking about, the richest investor out there, sooner or later, they all run out of money. And in order to keep investing, you need to then go after other people's money. And one of the sources of that, people don't often realize that they can use registered funds to invest in mortgages on Canadian real estate. So if you know someone who has money in an RSP or a RIF or something like that, some sort of registered fund, they can finance your property by loaning you money through the mortgage process. And typically they're going to get a far greater return, tax deferred as well, than they would by just leaving it whatever their investment is in right now.
And to add to that, if you have registered funds, then you can invest them passively in real estate as well. You can't give yourself a mortgage, unfortunately, to buy a property with your registered funds, but you can use those funds to invest in, well, I mean, it's technically called a mutual fund trust, and that's something that I've actually just launched yesterday, to be perfectly honest, where I've launched a mutual fund trust so that people can invest their RSPs, TFSAs, all that sort of stuff. So there are options.
Yeah. So the next point was you're buying the hotel in Quebec, but will you also buy hotels in Ontario?
I have 2 of them under contract in Ontario right now.
Next question, can I use a line of credit to invest in real estate? Absolutely.
Yes,
That's
of course.
where a lot of people get funding for real estate investment, for sure.
Most people start out using the equity they have in their primary residence in the form of a line of credit or a HELOC, home equity line of credit. That becomes their down payment on their first investment property.
Yeah, it's very common. I see clients of mine that do that.
And if you structure it properly, the interest on that HELOC is tax deductible. But I'll let the accountant speak to that.
That's true. The key is you just have to keep your funds, the usage of the funds separated, so you can prove that the money went to a income producing investment. Where you run into trouble is where you split up and you use some for a vacation, some to buy a new appliance, and some for investment purposes. You have to be very good at record keeping. Otherwise, CRA, the fun people that they are, tend to deny 100% of your interest deduction.
Right.
But as long as your paperwork is clear, you'll be fine. Okay, so they're wondering about the Residential Tenancy Act, which is what the new version of the Landlord Tenant Act in Ontario is called.
Mhm.
Why you're so sure that that doesn't apply to the hotel situation? So I think it comes down to the length of the stay, right? But you can expand on that.
Yeah, so I mean, a hotel is governed by the Innkeepers Act, whereas multifamily is governed by the Residential Tenancies Act. They are 2 separate laws that they fall under. So a hotel doesn't fall under the Residential Tenancies Act.
Right. And not, I guess the point is, not every living situation is covered by the RTA. For example, I believe it's still the case, if you share a kitchen or a bathroom with your landlord, you're actually under the Rumors and Borders Act. So you're not under the RTA in that case either.
Right, and there's other sort of distinctions that that govern the Innkeepers Act that that you need to follow, so that if you have somebody that's living there long term, But if you're following still the same rules when it comes to the Innkeepers Act, then it still keeps them under the Innkeepers Act, not under the Residential Tenancies Act.
Okay. All right, any more questions for Mark? Going once. Going twice. Going 3 times. No, okay, so thanks so much then, Mark. Again, I really appreciate you joining us and giving us insight into something that we actually haven't covered much at all in our group, which is the multifamily investing. So
My
thanks
pleasure.
again. And our next meeting is tentatively scheduled for April 27th, depending on how busy tax season gets for me. But it would be the same time, Thursday at 7. And I'll, of course, keep everyone informed through the normal email channels as to the timing and the topic. So thanks again, everybody. Thanks for joining us tonight, and hope to see you next time.
Thanks very much. Have a great night, everyone.
Yes, there will be a replay link sent to the group. It usually takes me about a week to get it out, so sometime next week. And there was a question, a last minute question there. Okay. So any last minute questions? No, okay. Thanks again. Good night, everybody, and we'll see you next time.
Thank you. Take care.
Bye now.
Thank you.